This year, 4 companies plan to spend $725 billion building data centers. Not the whole technology industry. 4 companies. That figure is up 77% from last year, and analysts already expect it to cross $1 trillion next year. America has seen spending like this twice before. Once, it built the railroads. Once, it built the internet. Both times, the infrastructure survived, and many of the investors did not. This is the anatomy of the AI investment boom. Start with what is actually happening. In 2025, Microsoft, Alphabet, Amazon, and Meta spent roughly $410 billion on capital expenditures, most of it on AI data centers. In 2026, their combined plans reached about $725 billion. Amazon alone is guiding near $200 billion. Meta has raised its own guidance twice, citing memory chip prices and new data center costs. The private market is moving at the same speed. In the first quarter of 2026, global venture funding hit $330 billion, and more than 80% of it went to AI. 4 deals absorbed most of the money. OpenAI raised $122 billion at an $852 billion valuation, the largest private round ever recorded. Anthropic raised $65 billion at $965 billion, briefly the most valuable startup on Earth. Both firms filed to go public in June. 3.5 years after ChatGPT launched, AI is no longer a product category. It is where most of the world's risk capital now goes. To understand how big this is, you need something to compare it to. Measured against the whole United States economy, AI capital spending now runs at more than 1% of GDP. The dot-com telecom buildout peaked at roughly 1.2%. The railroads, in their 1880s frenzy, absorbed an estimated 4 to 6%. So, on paper, AI is dot-com sized, not railroad sized. But there is a catch, and it changes the picture. A rail line lasts a century. Fiber lasts decades. An AI chip is typically written off in 5 or 6 years. Analysts at Sparkline Capital calculate that once you adjust for how fast this hardware wears out, the AI buildout already exceeds the railroad boom as a share of the economy. And the physical footprint shows it. Data centers drew 31 gigawatts of US power demand in 2025. That is projected to reach 41 gigawatts this year. Data centers now account for roughly half of all new electricity demand in the United States. Northern Virginia, Phoenix, Columbus, and Central Texas have become the corridors where this boom is literally poured in concrete. So why is this happening, and why now? The obvious answer is chatbots. The data points somewhere else. This is not software economics, where products scale at near zero marginal cost. It is industrial economics. Capability is bought with compute. Compute is bought with chips, land, and power. Frontier models keep improving as more compute is thrown at them. So every leap in capability must be purchased up front in concrete and silicon. That creates a brutal incentive. Executives at Alphabet and Meta have both argued publicly that the bigger risk is underinvesting, not overinvesting, because missing the platform shift could cost the company, while overbuilding only costs margin. Every player reasons the same way, so spending ratchets up together. The railroads ran on the same logic. Between 1863 and 1869, crews laid nearly 1,800 miles of track from Omaha to Sacramento, financed by land grants and debt, racing rivals for routes. So here is the real story. The AI boom is not a story about chatbots. It is the largest industrial infrastructure bet in modern American history, wearing a software costume. Follow the money, and the winners are unambiguous. Nvidia, which sells the chips everyone needs, is worth about $4.7 trillion. The most valuable company on Earth, Nearly every advanced chip it designs is manufactured by one company, TSMC, concentrated on one island, Taiwan. That single point on the map carries the boom's entire supply chain. The gains are concentrated in markets too. The 10 largest S&P 500 companies now make up about 38% of the entire index, up from 23% at the peak of the dot-com era. If you own an index fund, you own this boom, whether you chose it or not. There are quieter winners. Demand for robotics technicians is up 107% since late 2022. HVAC engineers, 67%. Data center construction is bidding up the skilled trades to six-figure pay. And there are quieter payers, communities near the buildout, where rising power bills have become a political flashpoint. Now the real question, does the revenue ever catch the spending? Honest analysts split into two camps, and both sides hold real numbers. The bulls point to revenue that is large, real, and accelerating. Amazon Web Services runs at about $150 billion a year, growing 28%. Google Cloud runs near $80 billion, growing 63%. Microsoft's Azure grew 40% in a year. OpenAI's revenue went from $13 billion in 2025 to a run rate above $20 billion within months. If inference demand keeps compounding at this pace, bulls argue, today's capacity will look scarce, not excessive. The way early fiber eventually filled with traffic no one had predicted. The skeptics answer with arithmetic. David Kahn at Sequoia Capital calculated the gap between what the infrastructure costs and what AI actually earns at roughly $600 billion a year. And it has widened since. An MIT study found that 95% of enterprise AI pilots produce zero measurable profit impact on $30 to $40 billion of corporate spending. And history offers a warning label. After 1996, telecoms poured over $500 billion into fiber. Years after the crash, 85 to 95% of it sat dark. Cisco was the world's most valuable company in March of 2000. It fell 88% and needed 25 years to see its old high again. The NASDAQ itself lost 78%. Notice what both camps share. Nobody disputes the spending, and nobody disputes that the technology works. The argument is about timing, whether the revenue arrives before the depreciation does. Here is why this matters even if you never buy a single share. The American economy is already leaning on this build-out. By conservative, import-adjusted estimates, AI-related investment contributed roughly a fifth to a quarter of U.S. GDP growth in 2025. The White House's AI advisor has claimed as much as 3/4. Whichever number you trust, growth without this spending would look very different. The grid is being reshaped. Data centers are projected to take 5.3% of U.S. peak summer power demand this year, and 8.5% by next. And through index funds, an unprecedented share of ordinary retirement savings now rides on 10 companies. Pension funds, target date funds, college savings, all of them carry AI exposure by default now. If the optimists are right, this is the railroad moment, and the infrastructure compounds for decades. If the skeptics are right, the investors take the loss, and the infrastructure remains anyway, as it did both times before. So watch one chart, the AI revenue line against the CapEx line. Whether those two lines converge and when decides which of those two stories this becomes.